Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Tuesday, June 4th, 5:13 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video. Market state, we are in a weak uptrend. See the trend gauge over here. We've got the four green arrows, but the fine print not as attractive as the headline arrow is. We've got a yellow sub arrow on market leaders, as several have come under pressure over the last week. And taking a look at the five major indexes across three time frames that we track, we've got the S&P and the NASDAQ 100 above their 21-day moving average, but the Dow firmly below, and mid and small caps breaking back below as well. Medium-term 50-day moving average, Dow's below there. Mid and small caps breaking that level again today. So the yellow sub arrow across those two time frames. Long term, the 200-day moving average. And remember, the market never gets into serious trouble unless we break the 200-day moving average on the major indexes. All five still above that key long-term level. So what happened today? Third straight day of weak in the morning, strong in the afternoon. Well, that applied to the NASDAQ 100 and the S&P 500, but mid and small caps weak basically all day. In fact, making 3-day lows. Here are the numbers on the day. Our 2121 leaders list down an average of 1.36%. We've got 6 leaders up, 1 flat, 14 down. Definite mixed bag on leaders today, and we've seen that over the last 3 days. The Big 8 up an average of 0.21%. The RG8, this is our 8 growth ETF composite, down 0.73%. S&P 500 opened down 0.15, went a bit lower from there. Early afternoon rally, late afternoon shake, but a strong recovery, ended up plus 0.15% on the day. Equal weight, however, down 0.3. So breadth not what we're looking for there. NASDAQ 100 up 1/3%, equal weight slightly negative, again, pointing to the breadth problem that you'll see in a minute. Dow up 1/3%, and here's the breadth problem. Mid caps and small caps, mid down 1.3, small caps down 1.25, just cannot get anything going there. Global 60/40 stock and bond just barely positive. Our flagship portfolio, GROTECTION, down by 0.1%. Some of our holdings, we've given back some gains. They're coming into key support areas. And let's see what we can make out of the charts. And we'll start here with the S&P 500. You can see after Thursday's shakeout and strong close, same situation with Monday, shakeout below the 21, strong close. Didn't even touch the 21 today, the 21-day moving average on the S&P. Let's take a look at it on a 15-minute chart here, and you can see here's the strong close on Thursday, which is making it look like a shakeout now below this 52.30-ish level. Strong open on Monday, fade, but a strong close. Mildly weak open today and a fade, but a strong close despite some afternoon shakeouts. But really, this 5,300 area now for the last 2 days acting as resistance on the upside. And that's right in the middle of this range going back to where we had the CPI gap up and the failed breakout above the 53.24 level. Really, it's a battle of bulls and bears. Neither seems to be able to get the advantage. It's been the bears with the advantage in the afternoon, and the bulls putting up a solid, or sorry, in the morning, and the bulls putting up a solid defense in the afternoon. Really, what it comes down to is a bunch of chop, but we are holding above the 21-day moving average. Same thing with the NASDAQ 100, holding above the 21-day moving average, not making much progress, but anytime we try to sell off hard, for the big caps anyway, money is flowing in. There's the NASDAQ 100. You can see it holding basically an inside day, holding above the 21-day moving average. Dow bounced back today, into the declining 50 and 21-day moving averages, bouncing off that 38,000 level. Here's where it gets rough. There's the S&P 400. You can see breaking back below the 50-day moving average, back to the support area right above the 2,900 level. So that really needs to hold. And then the Russell 2000, small caps breaking the 50-day moving average again and breaking the lows from last week. Big move down from yesterday morning's highs where we gapped up. Certainly disappointing for a lot of sectors that are small cap centric, and the relative strength making a new low well before price is always something to pay attention to. The VIX closing near the lows of the day below 14 at 13.16. The dollar below the 200-day moving average for the second straight day now. So dollar weakness continues. How did this carry over to the precious metals? Well, that inverse relationship. There are times when it's firmly intact, and there are times when it's not. It really doesn't seem to be right now. So down and breaking below the 21 and 50-day moving average was GLD today. GDX really got a hit, down 3.75%. We got stopped out of our remaining position on this. Held the 50-day moving average. Needs to hold right there, but out of the blue, big sell-off in gold stocks today. Silver down 3% as well, breaking below the 21-day moving average. So those two big gaps up over the last 2 weeks, completely given up. Extreme volatility there on the silver front. Bitcoin making a higher high, up 2%, a bit off of its highs for the day. Now over to bonds. Fourth day of bond price strength, meaning bond yield weakness. Normally good for stocks, but now the explanation on the lowering rates seems to be continued deterioration in economic conditions. Hasn't swayed the 2-year or pointed to the fact that the Fed will cut next week. There's still a 99% chance that they will not. But it's impacting the 10-year and the 30-year. So there's the broad bond index up 0.38%, the long bond TLT up 1.2%. So remember, we were in TPT and it was looking good. That was a failed breakdown on prices, a failed breakout on yields before reversing over the last 4 days in a major way. Here's the 30-year, the TYX. There's your failed breakout on the 30-year yield, 4 days down, and the 10-year, the TNX, failed breakout on that yield, 4 days down as well. From failed moves come fast moves. Always remember that Wall Street mantra. So that's our inter-asset correlation. Let's get to the tail of the tape. 10 a.m., JOLTS data week, 3-year low in job openings. That's considered anti-inflationary because there's no pressure on, no wage pressure if there's a lack of job openings. This was initially met with a spike up in the market and a spike down in yields, but those quickly reversed before the afternoon trend kicked in. Third day up, second day above the 8-day exponential moving average, third day above the 21. Our expectations remain positive as long as we stay above the 21 on the S&P and the NASDAQ 100, despite the deterioration below the surface in mid caps and small caps and breadth. We are mindful of it. It's why we're limiting our new exposure. Also because the RG8 look frankly terrible, and that's the pond that we fish in. So some stops are taking us out. We're sticking with our index longs, and we've been slow to add new positions. Sectors to the upside. Really not much that stood out except for, and I neglected to put that in, XLP. When staples are strong, that doesn't give you a good feeling. But again, this is another one of the reasons why we like the S&P 500 as a foundation, because all rotation takes place within the S&P 500. You can have some sectors weak, other sectors strong, and it helps to balance it out. On the downside, FFTY, this is the IBD 50 index, started out very weak on the day, still down over 1%. And again, that's an indication of what we're seeing overall with leaders. Oil's weak, banks weak, gold and silver stocks, uranium, copper, really uh, all weakness across the board in things that if you drop it on your foot, they would hurt. Those are commodities. Retail weak as well. Just two small sells in the portfolio, our remaining position in GDX and PDD. Slight reduction in our overall exposure from 1.19 to 1.14. Bottom line on the day, day three of weak morning, afternoon strength on the S&P and the NASDAQ 100. However, big lagging in mid and small caps and leaders staying mixed. Need to see some strength come back into leadership stocks. Let's get to the 21 over 21 and show the portfolio and what worked and what didn't today. So we didn't get back into Spotify, but it continued to break to the upside. Just doesn't seem to be the market where we are comfortable chasing strength. Bitcoin continues to hold up well. NVIDIA just continues to be the champ, making another higher high for 1, 2, 3, 4, 5 of the past 6 days. Pure Storage, tight range, holding above the 21. Transmedics, tight range, holding above the 21. Kava weak early, undercut and reclaim of the 8-day exponential moving average. Goldman continues to stay tight. Now on the downside, let's take a look at where did it go? That's kind of funny. All right, so they're playing games with me. All right, this is what was down on the day. Coherent, we added this yesterday on the new CEO and the massive volume. It gave back some of that today, and this is kind of what I mean by chasing strength. You see this in 9 out of 10 cases, it seems, lately. Freeport, sell-off, breaking below the 21 and the 50-day moving average. Vertiv bouncing where it needed to at the 50-day moving average. We still own some of this. There's GDX we got stopped out on. Abercrombie and Fitch bouncing at the 8-day moving average. ELF, we bought this yesterday. Again, chasing strength. Small 1% position, but no follow-up to the upside. Is that right? That it's up after? That's not a right quote. I wish it was, but that's not a right quote after hours. Not from what I'm looking at anyway. Down 3% today, but on light volume compared to the prior 2 up days. So we're focusing on volume patterns as well as the price, as always. And Howmet starting to show some relative weakness after being strong for a while. CEG bouncing again where it needed to at the 50-day moving average. Anything else that's a big standout here that I want to address? Not really. We're just don't have a lot of confidence with the weakness every morning, and then the strength is coming in the afternoon to salvage the day. But outside of NVIDIA, no big leaders that really make you stand up and say, wow, Bitcoin is looking pretty good. But we're keeping the cards close to the vest, so to speak. We did bid for some CrowdStrike after hours after getting stopped out on that with a big negative reversal last week after some sister stocks sold off. This is up 6% after hours, regaining the 50-day moving average and slightly above the 21-day moving average. So we re-entered that. We'll update that position tomorrow. With that, it's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. If you're interested in becoming a client, my partner can be reached by emailing dan@revereasset.com. That's CFA Revere President Dan Stewart. The phone is 855 Real Wealth. That's 855-732-5932. Reminder, our flagship portfolio is named GROTECTION because it serves a dual mandate, that is to grow assets in market uptrends, protect them in market downtrends. Different grades of how we protect them depends on how weak the market correction is. We break below this black line, the 200-day moving average, all bets are off under there. That's where all bear markets historically occur. Above that, we give the market different definitions of benefit of the doubt depending on where it is versus different moving averages and how leading stocks are acting. And if you're interested in this common sense approach, by all means, reach out to us. We'd love to talk to you about it. And that's going to wrap it for Tuesday, June 4th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.